Hello everybody and welcome back. Today with me there is Daisuke Nomoto, Head of Asian Equities from Columbia Threadneedle. Welcome Daisuke.
Thanks for having me.
Daisuke, we have seen a lot of up and downs in Japanese stock markets in the first half of the year. We have seen this sharp slump in March, and then this steep recovery since then. So what should we take away from that situation as investors?
We think the share price recovery, not only in the Japanese equities, but also in the global equity market, is attributed to the sizable monetary and fiscal measures that have effectively mitigated the liquidity concerns in the capital markets globally. The Bank of Japan announced numerous measures to reduce the impact of COVID-19, doubling its annual capacity to purchase ETF and real estate investment trusts, and also increasing the purchase of various kinds of fixed income securities. The total size of fiscal stimulus measures, all-inclusive basis, was $2.2 trillion, which is about 40% of Japan's GDP. It was actually one of the largest fiscal stimulus measures globally relative to the size of the economy, and it even exceeded the amount of Japan's stimulus measures during the global financial crisis. To be honest, the share price recovery in Japan has been somewhat quicker than we expected, but we believe the Japanese equity market is still attractively priced.
So Japan is still struggling heavily with COVID-19. So what traces does the coronavirus pandemic leave on the balance sheets of Japanese companies?
Sure. Let me make two key points. First is that so far it appears that Japan has been able to manage the COVID-19 situation relatively well, with the number of deaths per capita only 1 to 2% of that in more severely affected countries. The state of emergency was lifted about a month ago, and we are observing some pickup in the number of new cases in Tokyo just recently, but it seems that economic activity is gradually recovering. The second point I would like to make is the strong balance sheets of corporate Japan. Although the Japanese companies have increased the payout ratio of dividends and share buybacks over the last 5-6 years, still a huge amount of excess cash is sitting on their balance sheets. The total amount of cash on hand, excluding financial sector, is approximately $2 trillion, which is close to 40% of Japan's GDP. As a matter of fact, given the pandemic, we have witnessed some companies go under, particularly in areas such as the travel, restaurants, and the apparel industry. But in general, we would say the strong cash position in the Japanese corporate sector, along with the government support, prevented most companies from being squeezed financially.
So which companies and industries performed particularly well during the crisis so far in Japan?
Okay, in order to identify which industries and the companies can weather this crisis, we have focused our research into three groups. The first group is beneficiaries from the pandemic. We increased the exposure to those companies that are witnessing accelerating secular themes such as semiconductors, IT service and software, and e-commerce companies. And the second group is those companies experiencing short-term pain. We held on to the companies that are likely to feel short-term pain, but have the potential to emerge in a better market position. This includes factory automation companies and business service providers. And the third group is those companies we view as impaired. We stayed away from companies where their ability to survive is in question, such as airlines and some retailers with little competitive advantage.
So on the one hand, currently we see falling profits. On the other side, there is a price level that is near pre-crisis. So that means valuations go up. Is this a healthy development, or what should we think of that situation?
If you look at the economic indicators globally, for example, everything like consumption, capex, job data was negatively affected by the pandemic, with Japan no exception. But it seems that the consensus expectation is looking for the bottom of the cycle in the first half of this fiscal year in Japan, unless a large second wave of COVID-19 comes through. So there still is a divergence of earnings forecast for fiscal year 2020, mainly because 60% of the Japanese companies hasn't been able to announce their profit guidance, annual profit guidance yet. Having said that, based on our discussions with Japanese corporate management teams, the business conditions have been clearly improving, and it sounds like the trend of the recovery is much better than they originally expected. And interestingly, Japan has now become the second largest market for activist investors globally. Approximately a half of the Japanese companies in the Tokyo Stock Exchange Index is trading below book value, and the half of the non-financial companies are net cash, which is multiple times higher than that in the US and European equity markets. So clearly, Japan is one of the most attractively priced equity markets globally.
So where do you currently find value and investment opportunities in this exceptionally market situation?
Sure. So under any circumstances, we look to invest in the companies with sustainable competitive advantage at the reasonable price. Specifically, we look to invest in the companies with three major characteristics. One, high or improving return on invested capital. Two, strong balance sheet. And three, sustainable growth potential. Information sector looks quite attractive to us across hardware, software, and semiconductors at the moment. We also have a positive view on the industrial sector, particularly in the business service industry.
So how have you changed the structure of your portfolio during the last couple of months? And are there any examples of stocks that you are in favor of currently?
During the unprecedented volatility in the equity markets, we continued to stick to our disciplined investment process by focusing on the companies we want to own in the long term. Our bottom-up driven strategy has a strong bias toward quality. Like always, we have been upgrading the quality of our strategy by taking advantage of share price dislocation. We added to semiconductor exposure and gaming exposure so far this year. We initiated on a uniquely positioned business service company who provides the shareholder-related consulting services. On the other hand, we maintained underweight position in the financial sector and consumer discretionary sector. We sold out of the position in the bank sector, given the challenging industry environment from the low interest rates and high regulatory costs. So our framework effectively identified the companies with a competitive advantage. We focus on 5 key attributes to identify the company with an economic moat, namely intangible assets, cost advantage, efficient scale, switching cost, and network effect. We have held a company called Keyence for many years, as the company perfectly fits in our investment criteria. Keyence is a developer of sensors and machine vision equipment. The company is the beneficiary of automation, which we believe is a structural trend for the next decade globally. Keyence has a solid balance sheet, high return on invested capital, and is the lowest cost producer in the industry globally. It had 70% of its product ranked in the top market share globally, which is supported by their fabulous structure and the highly competitive direct sales channels. So, this is the classic example of our Japan equity strategy, namely investing in the best of breed Japanese companies where you cannot replicate the same exposure anywhere else in the world.
So what can we expect from Japanese companies the next quarters when it comes to the earnings situation?
Unless the large second wave of COVID-19 comes through, we expect the Japanese corporate profits to get back onto the recovery track. We think more companies will announce their annual profit guidance within a quarter or two, and we also expect the share buyback activities to resume sooner rather than later, since the Japanese companies have huge amount of excess cash to put to work. If this was the case, there would be a decent upside opportunity in such cyclically geared markets as Japan. Other swing factors for Japanese equities in the near term would be the US presidential election and the possible snap election in Japan. We wouldn't be surprised if the volatility in the equity market picked up in the short term, as COVID cases may rise from time to time in some areas. However, stepping back from the near-term headwinds, Japan's structural reform, ranging from labor reform to corporate governance reform, will be transformational for corporate Japan in the next decade, while a combination of attractive valuations and large stimulus measures will provide further support.
This was Daisuke Nomoto, Head of Asian Equities from Columbia Threadneedle. Thank you, Daisuke, for being with us today and sharing your views.
Thank you for having me. Have a great day.